I was working as usual when I suddenly received a notice. The company had disappeared. It's infuriating. 3 months of hard work, over 10,000 yuan, all gone. I don't even know if I can get any of it back. This footage shows a shoe factory in Wenzhou, China. The factory owner, burdened by ongoing losses and heavy debts, eventually couldn't hold on and fled, leaving a large number of workers without any way to claim their wages. Another factory has shut down. Over the past 2 weeks, more than 20 factories have closed their doors. Even selling the scrap metal isn't enough to cover the losses. This is the second factory to close. How many workers are now jobless? In this case, the factory owner also fled. The workers were well aware that the factory was struggling. Even though they hadn't been paid since June, they continued to show up for work, as wage delays had become a common occurrence. But instead of getting paid, they were left in despair when the owner disappeared. Desperate, the workers took turns guarding the factory overnight, hoping the owner would return so they could at least get the wages they were owed. Wenzhou, Zhejiang Province, is known as China's shoe manufacturing hub. Since 2001, when it was named the shoe capital of China, the region thrived on the shoe industry. But now, with weak demand and a sluggish market, it's already September and orders are still scarce. Once thriving shoe factory owners now say that life is worse than death. It's late August and still no orders. I don't know how much longer we can hold on. September is just around the corner, and there's still no sign of the market picking up. What are we going to do with this huge space and all these machines if we don't get some orders? This factory owner's wife sold 3 houses to buy a factory building, but more than half a year has passed and they haven't received a single order. All she can do is stare at the empty factory, filled with worry. If things continue like this, she'll have to go bankrupt and return home to farm.
This year in Wenzhou, I've seen so many shoe factory owners who can't even enjoy a meal. Since April, many factories have started closing and dozens are on the verge of bankruptcy. I'm not even trying to spread fear. This is just the reality of the shoe industry. Business gets tougher every year, and who could have predicted this wave of factory closures would hit so early this year? Last year at this time, everyone was busy, but this year, after the order meetings, many factories closed early. Some factories managed to produce a few popular items, shipping out hundreds of thousands of shoes only to see no reorders. The core issue isn't the factories themselves or the pricing, it's that customers aren't coming into the stores. Without customers, factories can't survive. It's not just one store. What if 100 or 1,000 stores have no customers? Without customers, who will keep the factories running?
Wenzhou's shoe factories aren't alone in struggling to get orders. This issue is widespread across China's manufacturing sector. In Guangdong, a major manufacturing hub, many factories are closing, and workers are being laid off or sent on unpaid leave due to a lack of orders. Unable to survive in the cities, many are returning home months before the Lunar New Year. As China's economy stagnates, especially in the private sector, numerous factories and companies are shutting down, leaving owners in debt and workers jobless with unpaid wages. These runaway bosses typically end up on the government's list of defaulters, known as Lao Lai. Their lives aren't any easier. They are forced to live in hiding, constantly on the run from debt collectors.
I fled. I've left behind my 60-year-old parents and my 2-year-old daughter. I'm all alone now. No one wants to stay with someone as deeply in debt as I am. Just 3 years ago, I was a successful business owner worth millions. I owned 3 toy factories and 2 food processing plants in Zhejiang. I'm not here to boast. I'm here to tell you that I'm now a defaulter. My glory days are over. All my assets have been auctioned off and I'm left with 1.8 million yuan in debt. I'm 32 years old and have never felt life was this hard. After all this time on the run, I feel like I'm reaching my limit. I'm sure there are many others like me, burdened with debt and left with nothing.
Some say there have always been defaulters in China, but this year there are more than ever. The root cause is the current economic climate. As income and profits dwindle, cash flow becomes tight. Companies with high debt are particularly at risk of financial collapse, and when that happens, the owners often end up as defaulters. Many people who lost their jobs have tried starting their own businesses, only to find that the harder they work, the worse their situation becomes. In this economic downturn, whether you're an experienced factory owner or a hopeful entrepreneur, success is hard to come by. This is the reality of the times, not a reflection of individual abilities. According to data released by the CCP on August 31st, China's Purchasing Managers Index (PMI) dropped from 49.4 in July to 49.1 in August, marking the sixth consecutive month of decline and the fourth month below the critical 50-point threshold that separates expansion from contraction. A PMI above 50 indicates growth in the manufacturing activity, while a reading below 50 suggests contraction. Additionally, China's factory prices dropped sharply in August, hitting their lowest level in 14 months. Breaking down the PMI, the production index fell to 49.8, indicating a slowdown in manufacturing activity. The new orders index hit a year low of 48.9, signaling a drop in market demand. The new export orders index stood at 48.7, showing continued weakness in foreign trade orders. The employment index dropped to 48.1, marking the sixth consecutive month below the critical threshold, reflecting a decline in manufacturing employment. The supplier delivery time index rose slightly to 49.6, but remained below the critical point, indicating continued delays in the delivery of raw materials. Caixin's analysis of the August PMI suggests that the ongoing contraction in demand is beginning to impact production. Meanwhile, China's non-manufacturing PMI for August reflects the challenges posed by weak demand and fluctuating prices in key commodities like oil, coal, and iron ore. The input price index dropped to 43.2, and the factory gate price index fell to 42, the lowest since June 2023. Chief macroeconomic analyst Wang Qing at Golden Credit Rating International noted that the sluggish real estate market has led to a lower operating rate in traditional industrial sectors like steel and chemicals. Consumer spending remains weak, further dragging down manufacturing activity. Moreover, with escalating trade tensions between China, the US, and Europe, external demand for Chinese exports is also under pressure. China's manufacturing sector faces growing challenges as the US and EU have imposed new trade barriers on Chinese products, accusing Beijing of creating excess capacity through government subsidies. Bloomberg economists Chang Shu and Eric Zhu commented that the consecutive months of weak PMI readings, including the recent unexpected decline in the manufacturing index, signal a bleak economic outlook. Furthermore, Bloomberg reports that recent data shows China's real economy loans have contracted for the first time in nearly 20 years. Fixed asset investment has unexpectedly slowed, and exports have fallen short of expectations. With the real estate and job markets both weak, credit demand remains sluggish. The severe downturn in China's manufacturing sector is reflected in the rising number of worker protests this year. According to a recent report from China Labor Bulletin, a Hong Kong-based NGO focused on promoting and protecting workers' rights in China, 757 worker strikes and protests were recorded in the first half of the year, up from 696 during the same period last year. The construction industry accounted for the most, at 47.8%, followed by the manufacturing sector, which saw 233 incidents, up from 197 last year. China Labor Bulletin researcher Zhou Aidan, as reported by Voice of America, explains that the shrinking manufacturing sector is driving workers to strike and protest. The main cause is fewer export orders, which leads to unpaid wages and factory closures. These problems often build up over months of delayed pay or reduced work due to fewer orders. Chinese analysts say the government is struggling to address the widespread worker hardships and factory closures caused by the manufacturing downturn. They point out that in the past, China's economy grew quickly, and unemployment wasn't a major issue because there were plenty of job opportunities. But now, the job market is saturated, and new investments in high-tech industries don't help workers much because these sectors need fewer employees. The decline in manufacturing is clear. During economic downturns, almost all industries struggle, except for a few, like oil, finance, and those supported by the government. Recent mid-year reports from publicly traded companies show how tough the situation is in China's economy. Over 5,000 companies on the Shanghai and Shenzhen stock exchanges have released their mid-year reports. Analysts say this year's stock market performance is the worst in 20 years. A Douyin finance commentator analyzed the data and concluded that China is going through an economic downturn.
今天咱就聊聊中报透露出的一些
Today, let's talk about some economic insights revealed in the mid-year reports. To improve data quality and comparability, we've excluded the finance and oil sectors from all the data. After these exclusions, the overall revenue of A-share listed companies fell by 0.9% year-on-year, while profits dropped by 7.8%. However, when we extend the timeline, we see that even in 2020, revenue still grew by 0.4%. A broad decline in revenue is very rare. Looking at profits, they've been declining for 2 consecutive years. This data clearly shows that we are experiencing an economic downturn. When looking at specific sectors, he analyzed that nearly all listed companies are seeing profit declines, with double-digit drops in the Shenzhen Main Board, Shanghai Stock Exchange Star Market, and Beijing Stock Exchange. He speculates that smaller companies are likely doing even worse, and the data confirms this. Only companies with market capitalizations of over 80 billion yuan showed growth in revenue and profit, while nearly all others saw declines. Companies with a market cap under 2 billion yuan saw profits plunge by over 100%. So how bad are the numbers? In the current market, there are only 105 companies with market caps over 80 billion yuan, representing just 2% of the total, while 21% of companies have market caps under 2 billion yuan, and 62% are under 5 billion yuan. Let's take a look at individual company results. This year's mid-year data also shows that 51% of companies had negative profit growth, and 1,159 companies reported losses, accounting for 22% of the total. This figure doesn't include companies that delayed their reports, which are likely doing even worse. Looking at the data from 2019 to now, the percentage of companies losing money has increased significantly, from under 10% in 2019 to 16.6% in 2020. When breaking down the data by company type, central and state-owned enterprises, or SOEs, showed revenue declines, while private companies saw revenue growth. However, private companies' profits fell sharply, with SOEs seeing moderate declines and central SOEs experiencing smaller drops. This indicates that in the current economic downturn, private companies are facing more pressure than SOEs. Upstream resources are typically controlled by SOEs, leaving private companies in the middle and lower parts of the supply chain, where they struggle with rising costs and declining product prices. As demand has reduced drastically, prices have dropped too. At the same time, private companies have been taken advantage of by the Chinese government. This also explains why so many of these companies have gone bankrupt in recent years. Even upstream resource companies are struggling. China's largest listed coal company, China Shenhua Energy, reported a 0.8% decline in revenue and an 11.3% drop in net profit for the first half of the year. Yankuang Energy Group's revenue fell by 24%, and net profit dropped by 31.6%. The entire coal industry is experiencing declining profits due to weak demand, especially from the steel and construction sectors, which are suffering from the ongoing real estate market slump. As of August 30th, 27 listed Chinese steel companies had released their 2024 mid-year reports. Only 4, including Nanjing Iron and Steel, reported positive net profits, while the rest continued to see declining profits and increasing losses. Ansteel reported the largest loss at around 2.7 billion yuan. Shandong Iron and Steel's revenue fell by 3.7%, and its net profit plummeted by almost 288%, with other steel mills also reporting significant losses. Analysts attribute these losses to a weak steel market. Downstream demand remains weak, and steel prices are fluctuating at low levels. Although raw material costs have also decreased, the decline is less than that of sales prices, further squeezing the profit margins of companies. According to the China Iron and Steel Association, China's steel production in the first half of the year was 530 million tons, down 0.94% year-on-year, while steel consumption fell by 3.3%, reflecting weak demand. The weak steel demand is closely linked to China's sluggish real estate market, now in its third year of crisis with no end in sight. Despite multiple government rescue measures, real estate investment continues to decline, and home sales show no signs of improvement. On August 30th, 16 major Chinese real estate giants reported a combined loss of around 100 billion yuan for the first half of 2024. China Evergrande reported a net loss of 20.3 billion yuan, a year-on-year increase of 195%. Sunac China reported a net loss of 16.7 billion yuan, Vanke 8.5 billion yuan, and Shimao Group 24.2 billion yuan. According to China Index Academy, the number of real estate companies with sales exceeding 100 billion yuan in the first 8 months of the year has halved compared to the same period last year, dropping from 12 to 6, while the number with sales exceeding 10 billion yuan fell from 90 to 61. The real estate sector has historically played a significant role in China's economy, once accounting for a quarter of the GDP and 60 to 70% of household wealth. The prolonged slump in real estate is now a major drag on China's economic growth. The economic slowdown is also evident in rising office vacancy rates in major cities like Beijing, Shanghai, Guangzhou, and Shenzhen. Some cities are seeing their highest vacancy rates in 20 years, even higher than during the COVID-19 lockdowns in 2022, with rents continuing to plummet. Colliers International reported that Shenzhen's vacancy rate for premium office space in June was 27%, up from 20% in 2022, with rents reduced by 15%. Knight Frank Greater China noted that Shanghai's vacancy rate for high-end offices in June was nearly 21%, up from 14% 2 years ago, with rents down 13%. JLL estimated Guangzhou's vacancy rate at 21% and Beijing's at 12%, both up from 2022 figures. Analysts believe that the weakening economy has led to a sharp decline in market demand, further eroding business confidence. Overall, every indicator points to China's economy sliding deeper into trouble. The manufacturing decline, real estate bubble burst, and ripple effects like lower consumer spending and rising unemployment paint a grim picture. With worsening international relations and foreign capital fleeing the country, this year may be tough, but it could still be better than what's coming in the next few years.